The problem from this video can be downloaded at accountingworkbook.com. If you go to the website, click the PDF link and you can download a copy of this and all of my problems for yourself. Now, if you check the website and you click on videos, you'll see there are more videos than those I've listed publicly on YouTube. You can see that there's every problem covered in the workbook has either a public video or a members only video. If you'd like access to the members only video, just click the join button beneath the video player on YouTube. All right, let's jump into the problem. Before I jump into the problem, we in this chapter are going to use a template throughout the chapter. You can find it on accountingworkbook.com. Just go under financial accounting videos, chapter 11, and link to cash flow template. So you'll see I'm using a template throughout the problem. You can just download it there. It's an Excel template. And anyway, there we go. Let's jump in now to problem 11.1a. The financial statements of bait and tackle are presented below, and there's a balance sheet and an income statement. And as a professional accountant, I often found myself in this situation, right? I would have done the other financial statements, the income statement, the balance sheet, the statement of changes in equity, or the statement of retained earnings, as it's sometimes called, and I'd be moving on to the cash flow statement, but I would have those statements in hand, and this is a very typical position to be in. As I read through the statement, cash, accounts receivable, inventory, equipment, AD, accumulated depreciation, normally we would just say equipment net and we would have subtracted that, but that's not how this statement is disclosed. Okay, fine. No issues there. I'm familiar with that. Accounts payable, we haven't seen this before. Income taxes payable, but you can very well imagine what that is. Company owes the government, right? It's just like an account payable to the government. Bank loan payable, common shares retained. Okay, so nothing new there. Looking at the income statement, sales, COGS, gross profit. So sales minus COGS is gross profit. Deduct the operating expenses to get operating income. Normally we would see like a list of operating expenses, salaries or depreciation or some other expenses coming there, but here it's just like the one-liner. Interest expense, income before taxes, income. So nothing new here, right? Like nothing new on the income statement. Okay, reading down, it says operating expenses are composed of depreciation, salaries, loss on sale of equipment, other operating expenses. Okay, other operating expenses are cash. My spidey sense is kind of tingling there whenever I see the word cash. Equipment was purchased in the year for $135,000 cash. All right, so again, we're working on a statement of cash flows. When I see the word cash, your spidey sense should tingle a little bit. Equipment was sold, again, for cash. There's that word. The original cost was $60 and the accumulated depreciation $45, and dividends were declared and paid during the year. Okay. Do a cash flow statement using the direct or indirect method or both. Well, in these videos, we're going to do both. In this video, we're going to walk through the direct method for the operating section. In the next video, we'll do the indirect method for the operating section. And in the third video, we'll do the investing and financing, which is the same, whether we go direct or indirect. As promised, we're going to use this template. Where is that template? There it is. I knew I left it somewhere around here. And I'm just going to fill it in by hand, but I do have the Excel version of the spreadsheet kind of handy for us. So let's get going to fill in the template. And to start, I want to give a title, and the title is the name of the company, Bait. Actually, I want to have a smaller font than this. Let's try that again. Bait, that's better. And tackle. We're doing a statement of cash flows for the year ended December 31st, 2024. Now, honing in here, we're going to focus in just on this section, just the direct method. And the direct method and the indirect method, let's just do a kind of side-by-side here. They're quite different, aren't they? The indirect method is longer. Believe it or not, students, I think, when you give them a template, would rather do indirect than direct if you made them choose, even though the direct method appears to be shorter. I think the direct method gives way better information to a user. So the direct method says, we're looking at operating cash flows and saying, here's where our money came from as it relates to the day-to-day business. So we collected money from customers, we bought merchandise, we paid our expenses, we paid salaries, we paid for interest, we paid taxes. That's where our money went to, right? Here's where it came from, and these are all where it disappeared from. So pretty straightforward, right? Just I could explain that to somebody. On the right side, it says, okay, net income kind of represents cash flow, but then there are things included in net income that don't involve cash, like depreciation doesn't involve cash, so we have to reverse it out. If I have a gain or loss on sale, maybe it does involve cash selling the asset, but that doesn't belong in this section. This is operating activities. Are selling long-term assets, that happens in the investing section. That is an investing activity, so that doesn't belong here. So we're reversing some things out. Then we're saying, how did a change in a current asset or current liability affect our cash? And again, it's almost, I don't want to say backwards thinking, but it's like indirect thinking. I think the word is quite right. So I prefer the direct method for the information it gives, but companies by and large have chosen the indirect method. I do prefer the direct method though. In any event, let's get down to business and let's prepare the direct method for this company. So the first line, cash collections from customers. We got to think, what is involved in collecting money from my customers? What accounts are involved in collecting money from my customers? And there's really two accounts that'll be typically involved here. Sales, because obviously if I sell to them, I'm going to collect more money. If I sell more, I collect more typically. And accounts receivable. That's also involved in collecting money from my customers. And so with the direct method, we do these little formulas. So cash collected from customers equals, I'm going to actually come back out here, sales plus decrease in AR. And let me explain what's happening here. It should make sense that the more I sell, the more I collect from my customers, so sales is a contributor. Why decrease in AR? Well, what happens when AR goes down? Why would accounts receivable fall? Really one big reason, there's a couple, but the main reason AR would fall is because I collected my money, so I don't have the AR anymore, right? So cash collections and customers is sales plus, if AR is going down, it means I'm getting the money. If AR is going up, it means I'm not collecting the sale, and it's bad for cash flow, so we would subtract it. And I'll put this minus increase in AR. Now, I won't always say this. If I say sales plus decrease in AR, it's implied minus increase in AR, right? Sales plus decrease in AR. If it's an increase, though, we subtract it. So let's see what's happened here. Our sales were $635,000. I'll just put K here. Accounts receivable, it didn't decrease, it increased by $14,000. What does that mean? It means I didn't collect all my sales, so I have to subtract this. This is bad for cash flow. Accounts receivable going up, bad for cash flow. You want accounts receivable to go down. It means you're collecting more of your money. Accounts receivable going up is bad for cash flow. It went up by $14,000. 50 to 64, it's $14,000. So I'm going to subtract $14,000. 635 minus 14 is 621,000. That's my cash collected from customers. Let's fill this in on our table. Cash collected from customers, $621,000. Okay, next, cash paid for merchandise. Cash paid for merchandise, let's just clean this highlighting up, involves a few accounts. The first one that pops into my head immediately is inventory. Inventory is merchandise, right? So obviously if I have more merchandise, I paid more for my merchandise. Cash paid for merchandise also often will involve accounts payable. And the income statement account that is involved here is cost of goods sold, because that's the merchandise that I sold. If I have higher COGS, I must have bought more merchandise to have available for sale. So cost of goods sold, accounts payable, and inventory are 3 accounts involved. Here's our formula. Cash paid for merchandise is cost of goods sold plus increase in inventory. Now, why plus increase in inventory? Well, if inventory goes up, it means I've spent more money on merchandise, right? If I have more inventory, I've spent more on merchandise. It's bad for your cash flow. Another way of thinking of it, if your inventories are going up, it means you have more money tied up in inventory. So it's bad for cash flow, right? It's more cash paid, more cash out. Plus decrease in AP. Now again, minus decrease in inventory minus increase in AP. Now let's talk about the decrease in AP one. Why is that more cash paid? Well, if AP is going down, why does accounts payable go down? Because I paid more, right? If AP goes up, it means I'm keeping the money in my pocket. I'm not paying my liabilities. If AP goes down, it's because I'm paying my debts, and it's bad for cash flow to pay your debts. It's more cash paid. So let's do the math here. COGS, 320 plus increase in inventory. What did inventory do? It went from 88 to 58. It went down by $30,000. The fact that inventory went down, we'll subtract it here. It means we have less money tied up in our inventory. It means we bought less inventory. This is good for cash flow. So minus 30K and plus decrease in AP. Let's see, what did AP do? AP did go down. That means we're paying our bills. We paid $8,000. There's an $8,000 difference there. So we add $8,000 because, again, if AP goes down, that's more money out of our pocket. That is more cash paid. So 320 minus 30 plus 8, 292, I think. 320 minus 30 is 290 plus 8. Yeah, 298. Oh, I'm glad I double checked that. 298 makes more sense. Yes. Okay, let's fill it in. Cash paid for merchandise is 298. Now, because this is a cash outflow, put it in brackets, right? It's cash paid. And all these ones that say paid, all these ones are going to be negatives because it negatively impacts our cash balance. Cash paid for operating expenses. Let's have a look here. It notes that operating expenses are composed of depreciation, salaries, loss on sale of equipment, and other operating expenses. I know the question because I wrote it. I want to jump ahead and I want to do salaries first, just because I saw it in that list. And let's do salaries first. Our salaries were $50,000. That was our salaries expense. Operating expenses are up here, 135, and salaries expense of 50 is a part of that operating expenses. Here's the formula. Cash paid for salaries is salaries expense plus decrease in salaries payable, or wages payable here. So our company's salaries expense was 50. Our decrease in salaries payable, let's see under liabilities, I'm looking for salaries payable. We didn't have any salaries payable. So because we didn't have any salaries payable, it was 0 last year, it's 0 this year, it's 0. It didn't increase or decrease, so it's just 50,000. I only included that because in a question you're doing, or in future questions in this workbook, you'll see that there is salaries payable, there are salaries payable, but in this question there just weren't, so we didn't have to deal with it. And our salaries expense just is our cash paid for salary. So let's plug that in, $50,000. And of course it is a negative amount to your cash flow. Cash paid for operating expenses, now we'll go back up to it. So you can see our operating expenses were 135. We've already dealt with salary, so I'm not going to include that here. Depreciation is called a non-cash expense Why is it a non-cash expense? It never involves cash. Think of the journal entry for depreciation. It's always the same. Debit depreciation expense, credit accumulated depreciation. Never credit cash. So we're not going to include that because I didn't pay cash for my depreciation. And loss on sale of equipment is the next one on the list. Well, loss on sale of equipment, $9,000. Yes, when I sell equipment, there is cash flowing, but this is not an operating transaction. This is an investing transaction. So I'm not going to include it here because this is cash flow from operating activity, so this $9,000 doesn't belong. That leaves us with $64,000 in other operating expenses, and the next bullet says other operating expenses are cash expenses. So let's pull in that $64,000 as a cash paid for operating expenses. $64,000. Cash paid for interest. I'm looking specifically for interest expense or interest payable. I do see interest expense right here, $1,000. I do not see any interest payable up above. The math would be very similar for as cash paid for salaries. Cash paid for interest. It would be interest expense plus a decrease in interest payable. And in this case, we had an interest expense. It was $1,000 just there at the bottom of the income statement. Our interest payable, we didn't have. So much like the cash paid for salaries, we can assume it was $1,000. Cash paid for income taxes. Did we have income taxes? The answer is yes. I can see my income tax expense right here on the income statement. I can also see income taxes payable. So these are the two accounts involved. Formula very similar to the previous two. Cash paid for income taxes. It's income tax expense plus decrease in income tax payable. I can see that's going to be behind my big head. Income tax expense is 43 grand. Income taxes payable went from 11 to 10. Now again, a payable going down means you're spending more money on the thing, right? So it's cash outflow here. So we're going to add that to our already 43,000 cash outflow. 43 plus 1, it did decrease by 1, gives us 44,000. I'm going to do a proof of this kind of at the end of this video just because sometimes students it helps sometimes. So 43 plus 1 is 44. Let's pull that in. Cash paid for income taxes is 44,000. Now we got a list of numbers to add up. 621 minus 298 minus 64 minus 50 minus 1 minus 44. I get $164,000. And this was positive, right? It was a positive number. This is an inflow from operating activities. It's not an outflow. Okay, we're basically to the end here, but I do want to just, sometimes students, if you're feeling a little shaky, having gone through all these calculations, sometimes students need a proof, or a proof helps for them to understand. And an easy proof for me to do is on this one. So again, if you're feeling okay about this and you just want to move on to the next video, go for it. But if you're feeling like, oh, I like a little bit more explanation, or maybe that'll be helpful to me, I want to prove this number, or just kind of tell you the story of this number, and that kind of explains why 44,000 is the correct answer here. So let's look at our income tax, the story of income tax payable, okay? So the story of income tax payable for this company. Their income tax payable started the year at $11,000 credit, right? That's the beginning. That's 2023's December 31st. Well, that's the beginning of 2024. So let's sort of start there. It starts at $11,000, and of course that's a credit balance account because it's a liability, and we can see it ends at $10,000. Now let's think about what happened with income taxes payable. Almost for sure, the company just paid its taxes, right? It owed $11,000 last year. It would have paid $11,000. And so that bill would have just gone away. So I'm putting it in green because that represents a cash outflow, debit income tax payable, credit cash, right? Ignoring this $10,000 at the end of the year. Now, during the year, of course, it did business and it accrued $43,000 in total income tax expense, debit income tax expense, credit income tax payable. So during the year, $43,000 in income taxes became payable. Now, we know they didn't pay all $43,000. How do I know that? They ended up with $10,000 left in their payable. So how much did they pay in income tax? Well, the answer is, well, they owed 43, they have 10 still owing. They must have paid $33,000 of their income taxes to end at $10,000. So what happened this year? They had an $11,000 bill, they paid it. They had a $43,000 worth of bill that probably accrued quarterly throughout the year. They paid 33 out of the 43, leaving them owing 10. How much did they pay in total? What was their cash flow related to income taxes in total? It was $44,000 in income taxes that they paid off. And so that formula, it reflects what likely really happened for this company, right? That formula that showed us $44,000 was cash paid for income tax. I hope my telling of the story kind of helped you to understand that concept. Okay, we're going to leave it here. We have completed the operating section, the direct method. In our next video, we'll go a lot quicker and we'll do the indirect method. Stay tuned. Bye for now.